Structured notes are complex investment products with returns linked to an underlying asset. They're often marketed based on their high coupon yields, downside protection, or some combination. The payoffs of structured notes can seem like a free lunch, but banks are not selling them to you because they're your friend. When you're having dinner with lions, you have to make sure you're at the table, not on the menu. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you why structured notes should be avoided by most investors most of the time. Structured notes are senior unsecured debt securities that have payoffs related to the performance of an underlying asset like a stock, a basket of stocks, or an index. If a bank can create a structured note, hedge its exposure to the payoffs, and sell it to consumers with a significant markup on their costs, the bank is getting a great deal. These products come in many flavors. For example, principal protected notes offer limited upside participation with downside protection, while yield enhancement products offer a guaranteed coupon yield and unlimited downside risk. There are many possible payoff structures, but the common thread is that structured notes are complex instruments. In economic theory, complexity may be used by firms to shroud some aspects of their products in order to exploit uninformed consumers, or firms may strategically create complexity to reduce the proportion of consumers who are informed. Theory predicts that more complex products will be more profitable for their issuers, which translates to higher costs for the consumer. With this theoretical background, the obvious empirical question is how structured notes tend to be priced. This is the part where the lion eats you. A 2011 study finds that the prices of a popular retailed structured product are almost 8% greater than their estimated fair market values and have mean expected return estimates slightly below zero. The authors explain that it is difficult to rationalize their purchase by informed, rational investors, supporting the idea that firms use complexity to exploit uninformed investors. A pair of 2011 studies find that samples of principal protected absolute return barrier notes and locally capped globally floored notes are, respectively, overpriced by about 4.5% and 6.5% on average. A 2014 study analyzes the ex-post returns of more than 20,000 individual U.S. structured notes, spanning reverse convertibles, tracking securities, and auto-callable securities, and finds that the ex-post returns of U.S. structured notes in the sample are highly correlated with the returns of large capitalization equity markets in the aggregate, and that individual structured notes generally underperform simple alternative allocations to stocks and bonds. A 2017 study finds that structured notes with higher headline rates, that is the best case scenario return for the product, are positively correlated with complexity and risk, and that higher headline rate, more complex and riskier products are more profitable for the banks distributing them. The authors also find that banks targeting less sophisticated client bases offer the most complex products. A 2021 study looks at over 28,000 yield enhancement products and finds that they offer attractive yields but negative returns, and they cost investors the equivalent of 6 to 7% in total annual fees. Net of fees, most products in the sample have negative expected returns, and simple combinations of the underlying asset and listed options dominate the structured notes. A 2022 study on barrier reverse convertibles in Switzerland finds that issuer margins are higher for more complex structured products, around 5%, and simpler structured products dominate more complex ones, while both deliver negative net returns to investors on average. Evidence presented in a 2020 study suggests that broker-dealers in the US intentionally drive up the prices of the stock's underlying structured products on the issue pricing date, resulting in higher prices paid by structured product investors, making their pricing even more disadvantageous to the consumer. A 2023 study finds that markups on structured products are partially explained by information asymmetries between issuers and investors. Structured product issuance increases when information asymmetry is higher, and issuers design products toward asymmetric information. In short, structured notes tend to be overpriced, and increasingly so with increasing complexity, and it appears that this is no mistake. In many cases, they have costs to the investor much higher than already expensive actively managed mutual funds, and they seem to be making investors worse off than simple low-cost portfolios of stocks and bonds. They can also be tax inefficient and are illiquid. Retail investors are being eaten alive. An important question, then, is why people are still buying these things. I think there are a few reasons, but not good reasons. Structured notes cater to investor biases and exploit their limited cognitive abilities. And investors fail to understand their expected returns and risks. Investors don't like losing money and overestimate the probability of a market crash. And many structured products offer some level of protection against loss. Investors also want to be rich, and again, many structured products offer upside participation, often connected to attention-grabbing securities or securities with high investor sentiment, both of which tend to go on to perform poorly. In other words, structured notes have higher payoffs in states of the world that investors, often irrationally, overweight. This leads investors to overvalue features of the contracts that appeal to their biases. Structured notes are often marketed on their easy-to-understand features like their coupon yields or their downside protection, while their expected returns and risks are less obvious and more difficult to evaluate. When positive features are clearly presented but risks are neglected by investors, the products appear artificially attractive. Structured notes are more complex than something like a simple index fund. It's relatively easy to look at an index fund and understand what you're getting. But the more complex payoff structure of structured notes means that assessing their costs, risks, and expected returns is beyond the abilities of many investors. All of these issues are only exacerbated by the fact that issuers seem to target structured notes toward unsophisticated investors. Finally, structured notes often pay much higher commissions to the broker or financial advisor selling them than a simpler, lower-cost product. Not all structured products pay commissions, but as always, it's wise to ask any advisor whether they have a conflict of interest before accepting their recommendation. High costs and expected underperformance relative to simpler alternatives might be acceptable for some investors who are sufficiently behaviorally motivated to achieve a specific payoff. But I think it's more likely that investors are simply unaware of the costs, risks, and expected returns of structured notes. When I asked Meir Statman, one of the founders of the field of behavioral finance, about structured notes on the Rational Reminder podcast, he explained to me that there is a difference between an error and a want. I might call investing in structured notes an error, but some investors might hear what I have said and still be happy owning them. An error is not knowing the trade-off you're making, while a want is knowing and proceeding anyway. You, dear viewer, are now shielded from errors and equipped to express your wants on structured notes. I started talking about structured products a couple of months ago on Twitter, and since then a few people, mostly people who sell structured products, have tried to make the case for their use to me. While I have not yet been convinced at all, I don't doubt that there are some niche cases where these products can make sense. But in general, I think most investors would be well served to avoid them most of the time. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who has tried to sell you structured notes.